Hey everybody, it's Chris with Life 180, and for this video, I'm going to be talking about Chapter 6 of Doug Andrews' book, The Laser Fund, and this is going to be one of the more controversial chapters because he is talking about the power of indexing. Now, indexing as a whole, on the surface level, looks really great, and in philosophy, conceptually, it is. My problem with Doug and with most IUL agents is they break it down in simple terms. They leave a lot of the important facts out, and they talk about indexing and how it impacts your money and the growth potential of your money, the protection of your money. They focus on all the good parts, but they don't really talk about the full picture, right? And so if you don't understand all the moving parts, if you don't understand how life insurance companies utilize indexing as a risk management tool for their own portfolio, then you don't understand how indexing or utilizing an IUL policy, an indexed policy, is going to actually perform for you. You don't know all the variables, and how can you plan for the potential moving parts, right? And so in this video, what I'm going to do is I'm going to go through this section of Doug's book, Chapter 6, The Power of Indexing, and I'm going to go through different talking points that he brings up, and I'm going to, go through the explanations, agree with him in certain areas, disagree with him in some, expound upon some of the ideas to make sure that I take the principles that he's leaving facts out of, and I give you the relevant information in addition to what he's saying. So I'm going to hop over here. I'm going to pop myself up in the corner, and we're going to go. All right, so you can see here, the power of indexing. Once again, I went through this on my iPad, read the PDF version, and we are just going to get into this. So he talks here, another valuable advantage of the Laser Fund is the opportunity to index your policy. I'm going to try to focus on my underlined stuff here. To be completely, so when you index your policy, it allows you to be completely protected from losses due to market volatility when the market goes down. How is this possible? Because your money isn't directly in the market, it's simply linked to the market. So you notice I have one green, one red. The green is where I agree with him and where I think it's cool that he's being honest. And the other area is where I disagree with him. The idea of indexing in a bubble, yes, it does protect your money completely from losses, but when you have the indexing participating in a index universal life policy, there are still charges with that. So even if you have a down year, that down year has a lot of negative impacts. Even though the principal is kind of protected, it has a lot of negative impacts in the performance of that policy, which can lead to more fees, especially in later years, especially if you're in retirement, and especially if you have policy loans out on the IUL. And so it's important to understand those things. I'm going to go through it a little more as we get through this section. So you can choose a single index, or you can link the policy to a combination of them. So he's explaining that you have different options with indexing. You can buy individual indexes. You can put your money, allocate your funds to a multitude of indexes. A lot of IUL policies will give 3, 4, 5, 6, 7, even up to 10. I've seen indexing strategies. So it's something to understand. Now I want to go through this section here because it's important. Because I want to read and show you how he describes how indexing works, like principally speaking. And this is pretty run-of-the-mill classic explanation from an IUL agent, because this is what they're sold. This is what all these companies sell agents on and train agents how to explain it. So he's talking about a point-to-point indexing strategy, and there are different types of strategies that you can do. You can do month-to-month, point-to-point, which is an annual thing. But on December 31st of last year, the S&P was 1,000. On December 31st of this year, the S&P increased to 1,100. That's a 10% increase. The insurance company is contractually obligated to pay you the yield, which is 10% on the $1 million. That means they will put $100,000 into your policy. That $100,000 is locked in as new principal. So here's the thing to understand on that. That is half true. In a bubble, once again, if there was no insurance charges, that would be true. But they're going to pay the 10% minus whatever your insurance fees are. So obviously, if you have that kind of money, depending on how old you are, how long the policy's been enforced, what the net amount at risk is for insurance, That's all going to play into the equation. So it drives me crazy when I see people just talking about these principles about how the indexing works in relativity to your money and your cash value, and they don't actually bring in the cost of insurance, because let's face it, the cost of insurance is an expense. So you have to go there. So now, the following year, there's a financial disaster. The economy tanks. While most Americans are invested directly in the S&P, while most of the Americans that are invested directly in the S&P could lose a significant amount of money, which millions of Americans did in 2008 and 3 and so on and so forth. I mean, it's happened a lot, as much as 40%, some more. Here's the great part. You don't, right? That's the big selling point to IUL. And from that perspective, in huge down years, yeah, there's a protection there, but that comes at a cost, and I'm going to go there. And so I can see, if you don't understand all the different moving parts, indexing looks super attractive. Like if I was a complete novice and I was reading this, I'd be like, wow, this seems amazing, right? With indexing, your principal is completely safeguarded from losses due to market volatility. What's more, every year your index resets to your policy anniversary, meaning if you had that 1,000 and now you earned that 10% and it went up to 1,100 or 1.1 million in his scenario, you're now locked in at that 1.1 million, and that is your base, right? Like, so that's what he's saying. You can't lose from there. Whereas if you gained in other areas, then that gain would be susceptible for the risk. So he goes here. So let's use historical numbers for a moment. Use an example where you're starting with $500,000 in your financial vehicle. On your anniversary date, on December 31st, 2007, so he's talking about right before the crash in 2008, the S&P 500 gained 3.53%. You would have received 3.53% in addition to your principal. With the laser fund, that additional $17,650 would have been locked in and now protected as new principal. So now you would have had $17,650, right? So then on December 31st, 2008, the index dropped 38.5% from the previous year. So he's basically saying you would be protected, and that's a good thing. And so, okay, all that is true. Then he's saying back in 2009, it gained 23.45%. So now you're earning the cap rate of 12.25%, because with the indexes, that's what happens. You have the 0% floor, and then you have a cap rate, 12.25%. Now, this is an opportunity for me to talk about a philosophy or a principle that I talk about a lot in my videos. A lot of people want to bang on me about this and say I'm a fool and this never happens, but I can tell you it happens all the time. Just do the facts, like go through the companies, research 10-year-old policies, 7-year-old policies. Here's the bottom line. This book was written in 2018. That's when it was published. If you have an S&P 500 index in 2018, guess what? A lot of S&P 500 indexes in IUL policies in 2018 did have a cap of 12.25%. Probably 2017 is when he actually wrote it, if it was published in 2018. But they did have cap around 12%, maybe 11.5 to 12.5% back then. Now those caps are already down to between 8.5 and 10.5% for S&P 500 index caps. And so this just goes to show, I mean, do a little history. This is just Doug in his own information showing that history, when you put these facts and these numbers on spreadsheets or in books, and then time goes on and facts change, evidence is pretty damning. The cap rates have gone down, and that's a huge deal. Later I'm gonna go. I say this is that the cap, and I think I wrote this later, but I'm going to talk about it now because I'm thinking about it. Cap rates are never going to stay at 12.5%. If you see my videos, you know how I feel about that. Cap rates are higher at the beginning of policies. They are higher because they are used as marketing expenses. Now think about, here's the thing with index universal life policies. They have typically 10 to 15 year surrender periods, meaning surrender charges in your policy lock up your money for 10 years, so you can't transfer it away, you can't access it the same way, I should say, put the emphasis on the wrong syllable. You can't access your money in the same in the same way you can like a whole life policy, because even though you're earning growth of the of the credited indexing strategy in an account, you can't access it because of the surrender charges. So the liquid capital of that money is not the same. So it's important to understand that. Now, with that said, these companies utilize higher cap rates at the beginning of these policies while the surrender periods are the highest. As the surrender periods go down and as your money becomes more liquid as time goes on, they release new products, they reduce the cap rates in these products, release a new product, and then all the while your cap rates go down. I mean, think about it this way. If you were somebody who bought this policy from Doug in 2017 at a 12.25% cap rate, the assumptions that they can give you, let's say he ran it for you to 7% assumption. That 7% was based on the fact that you had zero floor, 12.25% cap. If that cap goes down to 10, right, then your assumptions are going to be drastically changed because the cap now is about 20% lower than it was before. That's a massive change, right? So now all of a sudden your assumption is going to get reduced significantly. Let's say you reduce the assumption by half of that, like 10%. Now you're looking at 70 basis points. Now that goes down to 6.3 on its own, and it's going to get actually way worse than that. The actual performance would be way worse than that. Later in this chapter, he talks about the fact that you need to work with people who know what they're doing. He talks about that in every chapter. Talks about working with companies that have predictable cap rates. I can tell you, I have written right here, the companies he's worked with in the past, Pac Life, Fidelity and Guaranteed, and Minnesota Life, they all have histories. I mean, I could show you article after article, fact after fact of research that shows Pac Life, F&G, and Minnesota Life are historically known for reducing their cap rates and their policies. So it's just a bunch of malarkey, honestly, when it comes to that stuff. So let's see here, I get into that. So, and I'm talking about historically, companies have high early cap rates for marketing, they reduce them. It goes down, let's see here. Yep, that's all the stuff I just said about the surrender period, all that stuff. See, I get ahead of myself, I'm sorry. I should just follow my notes. I'd be way more effective probably. All companies drop cap rates, especially ones, what do I say here? Okay, so not all laser funds, especially those initiated years ago, offer the same features. Every company and policy is different. Be sure to check with your financial professional on the features and benefits of your policy. So I'm going to get into this a little bit. This is actually where it's going to get really, really fun. So especially ones with direct account. Okay, so here's the bottom line. I'm going to hop down here. So he gives this written example. So this is an example of how he says at the beginning, you're not actually participating in the index. You're tied to it, right? So you are putting your money, let's say you have $1 million of cash value like he talks about here. What you're doing is you're not taking that $1 million, and this is not accurate, by the way. I'm gonna explain it a little differently. And he tried, this is the area that I'm talking about where he simplifies it way too much. And I get why he's doing it. He's trying to keep it simple because it makes it easier to sell and it makes it look better than it really is. So $1 million of cash value, what he's doing is he's saying what they do is they take 5% of your cash value and they buy options with it, right? And then what they do is they say, okay, out of that, they know $950,000 is going to go into the general account for the portfolio, and that's where it's going to be invested, and it's going to get back with the earnings that they know they can get is going to get back to $1 million. What the $50,000 is used for that they take out is they take it out to buy options. Now that option, it's either gonna work, you're gonna have gains and you're gonna participate in those gains, and those gains will be credited to your account, or it's gonna lose and you're protected, and that is, it will be what it'll be. Here's the deal. Now, and if you lose, then that $50,000 is just gone. Let me just emphasize that. That's gone. And so what he's saying is that's how you get the 0% floor, because that $950 would turn back into $1 million in the general portfolio. And if you lose that, it's gone. If you gain it, it gets added to this bucket down here. I don't know why he doesn't have an arrow going from there to there, but he doesn't, and that is what it is. So let me see if I have a whiteboard. I think I do. Yes, I do. I'm going to open this up for a second. So I'm going to try to do the same thing here. I'm going to try to give an example here. Whoop. Oh my goodness. All right. Come on. What's going on? Oh, it's going to make me sign in. See if that works. All right, it did. We are styling. Let's go. I'm going to erase all this because I don't know what is that about. All right. Let's try to draw here now. All right, so basically what we're talking, we got $1 million, right? We got $1 million. So here's what happens. The insurance company doesn't just say we're going to take 50,000 and put it to the top and 950 and put it to the bottom. What they do is they look at it and they say, how much money can I earn? Are we going to earn in our general fund? What do we know that we're going to earn on this? Because remember, insurance companies know what their general account portfolio is going to earn that year. And let's say it's 5%. So if it is 5%, then they buy that. But remember, this book was written a couple years ago. Since that time, general account portfolios have gone down to actually 4 to 4.5%, right? So here's the important thing to understand. Now what's happening, let's just say it's on the 4%. So now what's happening is they say, oh, we can only buy $40,000 in options, right? So they take 40,000 there and they keep 960 stays here, right? And that is what it is because they know that they can get there, but it's not even really that clean. So I'm even messing myself up here. It's not even that clean because what they do is because 960 times 4% is not even going to get you back to even. So it would actually get you a little less than that. You got to use like 965. So it'd be like $35,000 in options because 4% of $1 million even gets you there, and it'll be like 965 goes here, and then that would get you to the general account invested, and that gets you back to $1 million, right? That gets you whole. And so that makes you whole there. Now here's the thing that's happening with IULs. The $35,000 now, this is why cap rates have to go down, because if you could buy $50,000 worth of options, as he showed in the book, on that $1 million, then obviously the potential for higher earnings in a good year is better, so you can get credited more. But here's the problem. These numbers down here, right down here, that 4.5%, that has a serious negative impact, right, on this number. But it also goes into more things, and he talks about this a little later, but it's important to not breeze over this principle. How it correlates to this right now is that options prices are going up, right? So that $35,000 actually buys you less options on a dollar for dollar basis than the $50,000 would have before. So now, whereas they go into options and then you either lose or you win, and if you win, then it goes back down, and if you lose, then it gets lost and whatever, but it buys you less. So whereas like in 2018 you had like a 12.25 cap rate, that cap rate is no longer, it's already had to be reduced to, let's say, 10%. And the reason is because option prices have gone up and because the general account performances have gone down. So you have less money to buy options with. That's what this is all about. And those options are more expensive. And so when you add the combination of that, the upside of the options are less than they used to be. And so therefore the cap rates have to drop. That's just common sense. Now, on top of that, as time goes on, insurance rates traditionally just drop cap rates over time because they know that these marketable rates are not going to be are not really sustainable, I guess is the way to put it. The cap rates that they sell, they knew if they put cap rates out there at 8%, 6%, 7%, that these things wouldn't be as attractive. So they utilize high early cap rates as marketing expenses, and they write it off. They write those losses off as marketing expenses on the insurance books. I mean, that's on the insurance company's ledgers. And so that's how they use those expenses. Like, it's important to understand that. Trying to think of what else I want to talk about here. I think that is good for this. I'm gonna hop back over to this and we'll get into more. So it's really important to understand those principles as we go through this. And we'll go, so I wrote simplistic and only half true. All right, so what if it gains? Okay, so they talk about, so now he's talking about if you take the $50,000 and you buy the options, what if it gains? It goes up 10%, $50,000 of your insurer spent on the options turns into $100,000, right? So it's earning, you get credited for that. If it goes up 20%, you get 12.5% or 12.25% of it because of the way it manages the options. Here's the thing I want you to do. I want to focus on this for now. Think about this like logically. I just showed you. Look it up. Anybody can research. What are the typical returns inside of an insurance company general fund? Right now, I have yet to see a general fund over 4.5% this year. Period. So think about it this way. All these IULs that are out there that are saying 6-7% is a good, safe. I mean, he always is harping on safety and liquidity and guarantee, like not necessarily guarantees, but really safety and predictable results, right? That's what he talks about that a lot in this book. If it were that easy and it were that straightforward and it were that predictable and safe, in an environment where the insurance companies are having a hard time getting 4.5%, if this were that good, why wouldn't the insurance companies be doing this for the entire general fund? It's because it doesn't work that way. And here's the deal. You want to find something just fascinating, go look at equity indexed annuities, right? So they use the same indexing strategies with annuities. Look at Nationwide, look at Pacific Life, look at F&G, look at National Life Group, look at any of these companies. And what you'll find is the annuity index rate in what they're willing to credit you versus the IUL is completely different. Why? Because they know that you can flip on the annuitization of that and guarantee cash flow instantly. And they have to make sure that they're protected if you're using that cash flow because it could hurt them immediately. With an IUL, they know that they have your money locked up in a surrender period and you don't have access to all your money, so that protects them. If you want to tap into that money or access it, it protects them. And by the time that surrender period expires, they're going to reduce the cap rates down to about the levels where the equity index annuity is. It's just common sense. If people would just use common sense about this stuff, you would realize that all these selling tactics are just smoke and mirrors, and it's just a way to sell a product, not to get you into what is best for you. So I do want to say, and I've said this a million times, I'm going to say it right here just because I know everybody's like, oh my gosh, Chris, you just are a hater of Index Universal Life. I'm going to say, if you run these at 4.5% and you're happy with the results, then you potentially could have some upside. And I personally am comfortable with the downside risk with an IUL with a 4.5% assumption, because that can weather all the markets. It gets you right expectations. It gives you, that's the real downside protection for expectation. I'm a big believer, plan for the worst, hope for the best. This gives you a plan where if at 4.5%, the income expectations and the performance of the policy is in alignment with your risk tolerance, then you may have some upside potential, right? Then it may be worth it from an income perspective. I've seen too many of these policies be run at $10,000 a year for 25 years, and then, with this promise of $50,000 a year of income, only to come out with, $12,000 of income, $15,000 of income. And if you're planning on 50 and you get 15, that's a big problem. So that's just something I would kind of let you know. All right, so I talked about this a little bit. Their option costs and the rate they're earning in the gap. So that, he's talking, okay, this is where I was saying he does talk about this a little bit, but here's the deal. The cost of the options are driven up by IUL companies. This is what I didn't talk about before that I was thinking I wanted to say. So here, this is like the IUL companies of the world have like created their own monster. They've like created their own problem. So when IULs first came out, there were not a lot of players in the market. There was a handful of companies, maybe 10 to 15 companies that were really in the IUL game doing any sort of volume. Now there's over 50, right? So now with over 50 companies, they're all getting into these options, right? So here's the deal. When the more people, the more competition there is for options, it's a supply-demand thing. The price of the options goes up. So the more popular Index Universal Life has become, and the more policies that have been sold because of these sales tactics, the more expensive the options go up and the more it hurts the cap rates. So they've like created their own problem. It's crazy. And they know that they've created their own problem. And what have they done to solve that problem? They've created their own proprietary indexes. And this is, once again, man, I'm horrible at this. I'm hopping ahead. But they've created, okay, so yeah, so he goes here. I'm gonna stop my statement right here. So you have a few important choices when it comes to your indexing options. Which index you'd like based on those offered by the policy. Insurance companies tend to offer some common indexes like the S&P, Dow, Russell 2000, so on and so forth, as well as some indexes they've designed exclusively for their policyholders. I have a note here, never buy exclusively designed indexes. Here's the deal, exclusively designed indexes look really good. And think about it this way, if I wanted to put together an index, what they do is they go, I want to put together this index because I want it to look good. So we're going to back test this index. And if I had the ability, because I knew I was trying to make it look good so I could illustrate certain illustrated rates, say 7% or 6.5% in an IUL, I could do research and I could build a basket of products, a basket of financial investments that led to an index with a certain performance. And I could just create whatever I wanted, then I could back test it and say, oh, this is back tested. Well, that's easy with hindsight. The most dangerous thing in the world is when, these back tested, and they're not very transparent about the fact that those assumptions are back tested. Yeah, if you dig deep in the illustration, you can find it, but it's not very transparent. But they're back tested, and then, you get into it, and, history is not indicative of future performance, especially in a back-tested situation where they're cherry picking the best investments to kind of create a specific result that they're trying to market and sell you, right? So be very, very cautious. The reason they're doing that is because when it's a proprietary index, you can then go buy options on that index. And because there's not as much competition to buy that index, the options are cheaper, it looks better, it's more affordable, but the performance of those indexes are kind of a joke. And so you need to be really, really cautious, right? Like it just is what it is. So then he goes through choices of index. I'm not going to spend a lot of time on this because there's millions of choices depending on how you go through. I'm a big believer, stick with the big ones. If you are going to do this, stick with the S&P, stick with the Dow, stick with indexes that you understand. S&P caps today are 8.5 to 10% right now, not the 12.25%. If you were, like I said earlier, if you were somebody who bought a policy in 2017 and you had a 12.25 cap and it's down to 10, how would that make you feel? It's not very good. It would negatively impact your performance. It would negatively impact all this based on the indexing cap rate. If this cap rate was not 12.25, not 12.25, not 12.25, but 10, 10, 10, 10, 10, that has a huge negative impact on this number right here, and that has a huge negative impact on your policy performance. The fact that and then there are blend indexes too that will blend some of the bigger indexes too. That's okay if you want to do that. It's fine. The other thing that they don't do when they do these things, the indexes, when you earn 12.25 or whatever, this has got as high as 15.41, which is ridiculous. I don't know what cap rate this is. Whatever it is. When you blend, when you look at whatever the cap rate is, and let's say it's a 12.25 up here, okay? I'm gonna go back up here. Let's say if it's 12.25, you don't really get that credited. You get that minus all your cost of insurance and expenses and all that stuff. So depending on your net amount at risk, your insurance rating, your age, all those things, your cost of insurance is gonna be what it is, and that has to be taken off of that. And if you're older, 55 plus, 50 plus, even in a lot of situations, these IULs are super dangerous. I mean, he's got this strategy of just jamming money into them and funding them up to the guideline single premium test, which, it allows you to get money in as fast into these policies in as fast as 5 to 7 years, which sounds really good. But the problem is you do that, but the surrender charges go longer, so you don't have access to all that money out of the gate. All the while, these cap rates get reduced, the performance doesn't go as well, it doesn't grow as fast as it's illustrated. So if you're older, when it doesn't grow as fast, the net amount at risk, the amount of insurance that you're paying for, winds up being higher. And as you get older, the cost of that goes higher and higher, and it eats into this 12.25% instead of it being 12.25% minus maybe $20,000 of insurance charges or $10,000 or whatever the number is, that number is bigger, and that has a real compounding negative effect on the performance of your policy, and that can get out of control in a hurry. So I'm just gonna rip through these indexing assumptions, all the different indexing options. Okay, and then he talks about interest bonus credits. You know, there's a cost to everything. He's saying, you know, some companies will give a 15% bonus. You know, so if you get 10%, they'll give you a 1.5% bonus on top of that. So they'll credit you 11.5%. Nothing in these policies is free. If there's ever a bonus, there's a fee to that baked in somewhere. They're not going to just give you bonuses for nothing. So don't let them sell you that garbage. All right. And this is this. So the top 5 takeaways on this that he has, and that is going to be the end of this chapter, is laser funds are powerful. Laser funds offer a powerful advantage over many other traditional financial vehicles because of indexing. So policies could never lapse if this were the case. Like the fact that he's saying it's a powerful advantage, if indexing was so strong and this was so, you know, strong, policies couldn't lapse. Remember, he was involved in a class action lawsuit where 24,000 policies of his lapsed. If you haven't seen my Doug Andrew Exposed video, go watch it. Look at the lawsuit. Look at the claims. There's no way 24,000. Listen, if it were a handful of people, if it were a couple people, I could say it's user error or whatever. But when you get to 24,000 people that have their policies lapsed, named in a class action lawsuit with Doug Andrew, Live Abundant, and his whole company as the sole named company, along with the insurance company that was named with him, that is not an accident. And so that just goes to show, if it were so powerful, that would never even be possible of happening on that scale. It's disgusting. So indexing allows the money in your policy to gain interest when the stock market goes up and be completely protected. Oh, that's where I should have made that comment. Yeah, it's not completely protected from losses due to market volatility, because obviously what I just said. Depending on your insurer, you can choose from among several different indexes, including S&P 500, Blended Index, Low Volatility Index, Bloomberg US Dynamic Balance Index. It's true, but be careful. Make sure you're not buying proprietary indexes. Super dangerous. You can also choose from among different crediting options, such as annual point-to-point, monthly sum, or trigger method. So that can be good. There are people that benefit from this. If you are super active in managing your IUL, some strategies can be better than others. You just have to, make it work. You have the flexibility to make choices that work for you, such as whether to leave your selected index and crediting option in place as your default or change it up year to year. That is true. You can change whatever strategy. If you're just comfortable with a year and you feel like you're confident the market's going to be what it is, you could just choose a strategy, let it sit. Next year, if you want to get more active in your management of your money, you can switch to a strategy that allows you to be more active with it. You just got to make a choice on how that goes for, what the best option is for you. So anyway, that is that section. If you haven't, at the end of this, in the end cards, I'm going to put a link to my IUL training series, because it talks about a lot of these things. It drills down a lot deeper in a lot of these strategies and a lot of how indexing actually works. Kept it pretty high level on this. It's a really complicated thing, and if you're going to be putting hundreds of thousands of dollars or putting your retirement well-being or financial well-being on the table with this, or at risk because of this strategy, you better know exactly what you're getting involved with, what your assumptions should be if you're going to move forward with this strategy, and what your expectations should be based on how these things perform. So that's it. If you found value in this video, please hit the like button. Give the thumbs up. That way, YouTube finds the algorithm. They love it. They share it with more people. That's the best way these videos get around to people. If you found value in this, share it with your friends, share it with other agents, share it on social media. Would really appreciate that. Any tags on me, TikTok at Real Chris Kirkpatrick now. Go check me out there. At Real Chris Kirkpatrick on TikTok. Check me out. That'd be awesome. Look forward to seeing you there. And as always, if you haven't already, make sure you hit the subscribe button, click the bell. That way you get notified every single time I launch a new video. And that'll be it. So I hope you have a blessed, inspirational day, and we'll talk to you on the next video. Take care.